Welcome back to Finance Orbit, your go-to spot for smart investing and achieving financial freedom. In our last episode, we explored the basics of dividend investing and its potential for passive income. Today, we're diving deeper into how to select the best dividend stocks for 2025. These are the stocks that can truly help you build wealth over time. Let's get started with some key strategies to identify those winning stocks. Not every dividend stock is a winner. Some companies might offer high dividends but can lose value over time. Others may grow slowly, yet provide a steady and increasing income. The key to financial success often lies in choosing the right stocks early on. Smart choices today can build lasting income for tomorrow. Let's talk about dividend yield. It's your first clue into a company's payout compared to its stock price. For instance, if you have a $100 stock that pays $4 a year, that gives you a yield of 4%. But hold on, a higher yield isn't always a good sign. Sometimes it can mean the stock price is dropping or that the payout isn't sustainable. A healthy yield typically falls between 2% and 6%, indicating steady growth. Check out this chart comparing yields, showing you the safe zones versus the risky ones. The payout ratio reveals how much of a company's profit is returned to shareholders as dividends. If a company pays out 90%, it leaves little room for growth or reinvestment. A healthy payout ratio is typically below 70%. This means the company retains enough cash to invest in its future and maintain dividends. Visualize this as a split, 70% for dividends and 30% for reinvestment. A great stock doesn't just pay dividends, it increases them every year. Look for a solid 5 to 10-year track record of consistent growth. This reflects management's confidence and the company's long-term stability. An ideal dividend growth rate is between 5% and 10% annually. This kind of growth is key for compounding your returns. Check out this graph showing the rising dividend payouts over the years. Stable companies keep paying dividends, even when the market gets rough. Look at sectors like consumer goods, utilities, and healthcare. People always need these essentials. In times of uncertainty, stability is more valuable than fleeting trends or hype. Imagine a calm graph amidst a stormy market, showcasing the resilience of brands like Coca-Cola, J&J, and Procter & Gamble. Instead of cashing out, think about reinvesting to buy more shares. This is how you create a cycle of compound interest, money turning into more money. Don't put all your money in one sector. It's all about balance. Combine defensive stocks like Procter & Gamble with growth sectors like technology or renewable energy. A mix of 5 to 10 strong companies across different sectors can really provide resilience. Think of it like a pie chart of sector diversification. Investing $5,000 with a 4% yield can lead to amazing growth over time. Remember, compound growth is your best friend. Before you invest, always do your homework. Check out platforms like Yahoo Finance for stock insights. Seeking Alpha is great for in-depth analysis. Morningstar offers comprehensive ratings and research. And don't forget apps like Simply Wall Street for visual breakdowns. Dive into financial statements and payout histories. Look at analyst ratings to guide your decisions. Remember, knowledge is power when it comes to investing. Let's dive into two popular dividend stocks, Coca-Cola and AT&T. Coca-Cola offers a steady 3% yield with consistent growth. On the other hand, AT&T has a higher yield, but its performance is quite unstable. Over the past 5 years, Coca-Cola's total return has outperformed AT&T. This really shows that quality can beat quantity in the long run. If picking individual stocks feels overwhelming, consider dividend ETFs as a smart alternative. They bundle multiple companies together, which helps lower your risk. Some top choices to look into are VIG, SCHD, and HDV. These ETFs have proven to be solid performers with reliable payouts. Visualize this with ETF logos and an animated graph showing diversification. Avoid these 3 traps when investing. First up, chasing those high yields. They often come with hidden risks. Next, don't ignore the fundamentals. Debt and cash flow matter more than you think. And please do your research before buying. Buying without knowledge is a recipe for disaster. Remember, consistency beats speculation every time. Let's talk about building a balanced portfolio for 2025. Start with 60% solid dividend stocks to create a strong foundation. Next, add 30% dividend ETFs for diversification. Finally, keep 10% in cash or growth assets for flexibility. Remember to reinvest those dividends regularly, and don't forget to track your performance every few months. Balance is key to long-term success.
With rising interest rates and inflation, the value of stable cash-generating assets is on the rise. Dividend investing isn't just a relic of the past, it's a cornerstone of modern financial independence. Imagine building a future where your investments work for you, generating income even while you sleep. It's not about chasing trends, it's about creating a sustainable income stream that lasts. In this evolving financial landscape, dividends can be your safety net and your path to freedom.
Hey everyone, I want to hear from you. What's your favorite dividend stock or ETF for 2025? Drop your picks in the comments below. I'd love to feature your suggestions in a future video. Let's build a community of smart investors together. Thank you for joining us at Finance Orbit. If you found value in today's video, please give us a thumbs up. Share it with friends who could use some financial tips. And don't forget to subscribe for more insights. Remember, your journey to financial freedom starts with one smart choice today.